let's go to what does this process look like? A key piece about this is the assumption is that you're trying to offset active income. So Farhan, do you want to walk through what does this look like step by step?
Yeah. So assuming you're active in solar, the way this whole structure works is you set up an entity, as Mani mentioned, you are entering in a renewable business. So you're setting up an entity, and our accounting partners recommend you set up a multi-member entity between you and your spouse or a trust. That entity buys solar projects. We can talk about the specific structure, whether it's a flip partnership, complete ownership, or partial ownership. By buying those projects, the projects are going to throw off credits and depreciation, and the entity is going to be passed through. So you would be able to get those credits and depreciation yourself. In order to take advantage of those credits and depreciation, you can use them against your passive income. But if you would like to use them against your active income, the important piece is you have to be active in solar. You have to spend a minimum of 100 hours in a renewable energy space. The entity that you're setting up can own multiple projects. You don't have to spend 100 hours in each project. Your material participation is in the entity that you are setting up. So your entity can own 10 different projects. You can't spend 100 hours in each project. You will be active in your entity and you'll spend 100 hours in that entity. And the activities Mani was talking about, going on a conferences, watching educational videos, learning about the industry, doing an site visits, vendor selection, so it will be substantial to the project. You got to be active if you are writing off active income. Now, you can take those credits and depreciation, use them against your active income if you are active in solar. And then the projects are going to also throw off income depending on which structure. The income is variable between 2% to 5% per annum based on your purchase amount. So you set up an entity, that entity buys the project throws off credits and depreciation. If you are active, you take those credits and depreciation and use them against your active income. And then you are also entitled to income stream, which is 3 to 7%. It's outlined here depending on the structure you choose. So we'll dive into what structures are. First we'll cover the benefits, but then we'll dive into what structures are there and how they work.
It's really important piece to call out. One is you're setting up an entity here. That's the entity. We're going to own these assets. You're going to run your business. You're going to work with vendors, spend your time. I've seen a couple of questions as to how do you track these hours. We'll jump into this later, but we actually have kind of online as part of our platform. We have a online log where you can upload videos, photos, add context of what you're doing, track your hours on an annual basis, and see how much you have left. And so really plan about that. But you'll do that in the entity. You'll purchase these projects, these assets, run your business. The benefit, there's the tax credits, depreciation, and also the income.